Today we're going to talk about investing lump sum money. If you have some money in your bank account you'd like to put away, what's the best way to do that? Let me bring across Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us. We always talk about using SIPs, and that works for those of our viewers who are salaried. But let's talk to those who are not salaried, who might have funds not available every month. But if they have a lump sum right now, how important is it for them to systematically invest that money? And would you agree that using an STP is the best way to go?
The reason why investors should, invest regularly over a period of time in equity is to mitigate the risk of assuming, catching a market high. That apart, it is also psychologically very comfortable, or it's very unnerving that you invest a large sum of money at a point and you see the market crumbling in a brief period of time, and market can be very unnerving soon after you invest. And if that is the case, then it can derail all your plans. So that is why it is very important that for individual investors who don't have experience of investing in equity over a period of time, they should not be investing lump sum. They should spread their investment, even if they have irregular income, which is not necessarily monthly income. If you are not a salaried person, even then you should invest your money in a fixed income fund, move your money gradually into equity to average the risk, to average your investment, eliminate the possibility of catching a market peak, and be on a plan of methodically investing in equity.
In fact, we have a question from one of our viewers. V. Krishnan has written in. He wants to invest some money in the market for safe and fixed returns, and he wants you to suggest an investment that will give him better returns than a fixed deposit. So obviously, if he wants a safe and fixed return, then investing in the stock market is not a good idea. Dhirendra, what are his other options?
If you are looking for a reasonably safe and not necessarily volatile, and you are willing to compromise on liquidity, which means that you are unlikely to need that money for a defined term. If you are able to define that term, whether it be 3 months, 6 months, 2 years, 3 years, and enhance your return, the idea is to enhance your return compared to bank deposit. I would say that fixed maturity plans are a reasonable choice. These funds, once you invest your money, the money gets locked in for the term of the plan. But the advantage is that you get little more return than fixed deposit. The other thing is that the return that you get from FMPs is more tax efficient, because if it is held for a period of, if the term of the fund is over 1 year, then the return on this fund will be treated as capital gains, which is indexed to the cost inflation index. And so effectively, for a 1.5 year time frame, what we have seen in recent past is, going by the state of inflation or the level of inflation, the return from these funds are proving to be tax free.